Welcome, everyone, to this evening's or today's presentation, U.S. Outbound Moves for Tax Effectiveness. I'm Ashley Murphy, the founder and principal of Arete Wealth Strategists Australia, and I'm thrilled to be joined here by John Versace, one of Australia's leading financial planning experts in the area of Australian and U.S. Financial planning matters. So welcome, John.
Thank you, Ash. Great to be joining you today.
Indeed. Well, I just wanted you to be aware here that all of our presentations are recorded. We post them up the next day on our YouTube channel. We have over 50 different presentations that are available there, including last month's presentation on the next installment on my family's experience in living a cross-border life. But also the previous presentation John and I did together back in April, as well as a case study in Stock Awards, as you can see there. A little bit about me. We'll mix it up here this month, John. I'll introduce myself if you want to introduce yourself. So as indicated a moment ago, I live in Australia and the US. Currently, I'm in Minneapolis here for the summer and then returning back to Australia for August through December, and then I'll be back here just because I love the freezing cold, back here in Minnesota in December and January, before returning to Australia through August of next year, and then coming back again to the US after that. So really, I've lived this cross-border lifestyle since birth. Grew up in Brisbane, Australia, went to the University of Queensland, moved to the US in 2005. So I've lived in the US for 16 years. And it really dawned upon me there had to be some sort of organization that supported those that had financial planning matters that cross borders. Turns out there wasn't. So I went and founded the Global Financial Planning Institute. We have over 300 advisors in that organization. We run a masterclass to teach financial advisors about the very issues that we're talking to you tonight about. John, just handing it over to you here.
Yeah, thanks, Ash. So I'm John Versace. I'm a senior financial advisor and the head of the expat services team at Apt Wealth Partners. So Apt Wealth is an Australian-based financial advice firm. We've been around since the late 1980s, and we look after around $2.5 billion on behalf of our clients. But we have a dedicated team that's there to service the needs of the cross-border Australian and US clientele on the Australian side of things. So that's the team that I head up and specialize in.
Fantastic. So just a few disclosures. No presentation from a financial advisor would be complete without some disclaimers. And of course, I would say you would do well to obtain personal financial advice, personal tax or investment advice, as what we're talking about here is really general in nature. Taken from materials known to be reliable, but of course you would do well to obtain your own advice. And John?
Yeah, and same for us. So, everything we discussed today is general in nature. So we're not taking into account anyone's specific personal circumstances. So if you're seeking personal advice, do reach out to a professional.
Absolutely. The kinds of issues that Arete Wealth Strategists Australia works with their clients on, these three client types are a good indicator: the Aussie business owner, the high net worth family getting settled in the US, or the Aussie executive and family permanently relocated to the US. I've got listed there the sorts of issues that we work with. We're a US registered investment advisory firm, so we're able to help clients with their US assets, and John is very well placed to assist on the Australian side of things. Okay, so an outline for today's presentation looks as follows. I'm going to go through very briefly and talk about the implications of one's legal immigration status in the US, your legal status. John's going to be talking about US taxes on Australian assets and problem areas that arise there, before talking about the HART Act, everyone's favorite topic, of course. And I'll be talking about distribution of retirement accounts back to Australia and how that works depending on your legal status. John will be going through some estate planning points before I'll round things out with just a quick public service announcement on US tax compliance matters to do with FBAR and FATCA. All right, so getting straight into that, implications of one's legal immigration status in the United States. Well, here's what we have. It's important to note this about the US, that for the purposes of taxation, if you are considered a US person, if you're a US citizen, no matter where you are, where you go, what you do, you're a US tax resident. Same applies to a US permanent resident, assuming that they haven't relinquished that or submitted their form I-407. Or if you pass the substantial presence test, which actually has no relationship whatsoever to your legal status. So if you're merely in the US for 183 days, and there is a formula, a little bit more than we need to go into tonight, but there's a declining number of days that count for the prior 3 years. And if that tallies up to 183 days, congratulations, you're a US tax resident. And it's important there that you can see, why is it important? Because no matter where you go, no matter what you do, you're a US tax resident, which doesn't necessarily mean you're going to end up owing a whole bunch of US tax. But what it does mean for sure is that you have US tax filing assessment obligations. And so you would be determined whether you actually owe anything or not. And certainly the informational reporting that I'm going to be going over at the end. But what happens to a visa holder, a legal permanent resident, or a citizen, should they renounce their citizenship, or in the case of the permanent resident, surrender their green card, or in the case of the visa holder, simply not be in the US? And what happens there is, after leaving the US and not passing the so-called green card test, which is as the name indicates, for the permanent residents or citizens, or being physically present in the US, then you're no longer subject to the US's citizenship-based taxation. And you can see here, I've taken a slide from the GFP masterclass to indicate the different types of tax systems we see around the world. And so it's a fundamental point to make, and that's why I included this slide, is I wanted to show you how merely being a resident of most developed countries would result in you being taxed on a worldwide basis once when you're considered a tax resident, which is typically when you're physically present in that country. The US is different. So that's the point I'm really trying to bring home. It doesn't matter if you're in the US or not, you're still going to be a US tax resident. So just handing over to John here on this topic.
Yeah, so as Ashley mentioned, unfortunately for those that are coming home from the US, some of you may still need to file US taxes, and that they are the US citizens or green card holders that are coming to Australia. And there is some protection for you in terms of paying double tax. So there's protection with the foreign earned income exemption on I think it's 106,000 of US tax on your wage, and also typically anything that's on your Australian return, personal Australian income tax return that is taxable in Australia will typically be offset against your US taxes. However, there are some real problem areas that you've got to be aware of, mostly around the assets in Australia that you have. So the definition of a US person there is really important. So it is a citizen or green card holder. But these are the problem areas here. So and some of the problem areas. So the first one we've noted there is non-US indirect investments that are so Australian ETFs, managed funds, stapled securities, property trusts, listed investment companies. Really anything that's domiciled outside of the US that's not a direct investment. So any indirect investment will typically trigger what they call a passive foreign investment company, or PFIC, as it's otherwise known. And the meaning of that for US taxpayers is that essentially there's extra reporting for each one of those investments that you own. So if you've got 5 or 6 ETFs that are domiciled outside of the US, extra reporting for each one of those, which is really costly on the US return, and the extra tax that you need to pay can be quite onerous on the US return. It is a complex tax calculation, but it is often the increase in value each year is taxable in the US, plus the income at the highest US income tax rate. So, you really want a very good reason to be investing in one of those investments if you are a US taxpayer. Superannuation is a real grey area for US tax. The IRS have never come out and said this is exactly how we're going to treat superannuation for US tax purposes. So you will see some different treatments from different tax practitioners, but I guess the what we mostly see from most accountants is, well, pretty much every accountant would agree that contributions that are mandated by your employer, even though they are concessionally taxed and not included on your income tax return for Australian tax purposes, will typically be taxable on your US return. So they don't recognise that your super guarantee contributions that your employer's putting in is a concessional tax. It just typically goes on your US income tax return. The earnings within your superannuation fund each year will typically either be taxed on your personal income tax return as though they're earnings in your name, or they're taxed on drawdown in retirement. So there's different factors that will determine on whether you will be taxed on your income tax return each year or on drawdown, but that's usually the way it works. And then also you've got to be a bit careful how much you put into superannuation. So most accountants would agree that if you put in more into your superannuation than what your employer has put in through mandated contributions, that it will trigger what they call a foreign grant or trust treatment of your superannuation, which opens up a whole range of issues, from extra accounting costs that they can be pretty significant. The accounting costs, there's typically look-through provisions where the US will essentially look through that structure and essentially tax the earnings within the superannuation in your name, and then they'll look at what the investments are actually held within the superannuation structure, and most of the time it will be those PFIC investments that we noted under point 1, and that opens up some other issues as well. So superannuation is a great vehicle in Australia, but it can it can be really complex, and some of the tax benefits that Australians get to enjoy can be unwound when you throw in US tax into the mix. Self-managed super fund, again, like I was mentioning there, it is typically like where you contribute too much to super, foreign grant or trust treatment. The US will typically look through that structure and tax it as though it is an investment in your name, extra accounting and a range of issues if you own certain investments within that SMSF structure. So just going on to the next slide here, the family trust again. Now, family trust can be a great vehicle from an Australian tax perspective. Tax planning, the earnings within a family trust are usually able to be distributed out to members of your family group, depending on who's on the lower tax bracket, and it can be a great way of lowering the overall income tax on investments. But unfortunately, from a US tax perspective, the US again will typically look at this sort of structure and it will be classed a foreign grant or trust. And when there is this look-through provision, essentially, or where it is a family trust that an individual has contributed to capital or is controlling the family trust, then it will be taxed in their name, and there isn't the ability to sort of pick and choose who receives the capital and income each year. The family home is a really big one to be aware of. So as most of you would know, that the family home from an Australian tax perspective, as long as you sell it whilst you're a tax resident of Australia, most of the time, depending on circumstances, it will be a tax-free capital gain sale, so that it's exempt from capital gains if it's being your family home through the period of ownership. But from a US tax perspective, in some cases that won't be the case. So for a US taxpayer where there's more than 250,000 of capital gains, the portion above that 250,000 is taxable and will be applied capital gains tax in the US. The other thing as well is that, and this is, one that we see a lot of people miss and not be aware of, is that you can actually pay a tax on the repayment of your Australian loan when you are paying US taxes. And I'll explain it using an example because it is a difficult concept to explain. That if you, let's say you take out $1 million loan in Australia on your Australian property, and assume at that point in time the Australian and US dollar was at parity in terms of the currency exchange. So it was dollar for dollar. And then you kept it as interest only. And in 5 years' time, you get a windfall from an inheritance or some other means, and you decide to repay that debt. At that point in time, the Australian dollar loan was $1 million, but the US dollar value of the loan had decreased to $750,000 because of the currency exchange purely. That $250,000 from when you took out the loan to when you repaid the loan in US tax terms is typically a taxable event in the US. So that is a really big one that we've seen, unfortunately, some people be caught out from. The last one on your screen there is corporate structures.
John, if I may, I just wanted to make a point there that the term I use for that is foreign tax asymmetry. So that is, you can have gains, it's ordinary income taxable, but if you have losses, foreign exchange losses, it's not deductible. So that's a really good point as well. Actually, unfortunately, it doesn't work in the other way, and that's right. If there's a loss, it's no benefit whatsoever. Where it's essentially a decrease in value in the US dollar terms, unfortunately, there's typically a tax to pay. So that's that's unfortunately it's probably one of the worst ones I've seen in the US Australian tax system, but it's a reality, unfortunately. And the last one there is controlled foreign corporations. So it's a really complex one. I won't go into a lot of detail on this, but it applies to corporations that are domiciled outside of the US, company structures that are owned more than 50% by a US person, and each US person owns at least 10% of the vote of the company. It can lead to this controlled foreign corporation treatment, and it does become very complex in terms of the tax outcomes from a US tax perspective, and it can unwind some of the benefits that you do get from setting up a corporate structure from a tax perspective on the Australian tax side of things. So I guess, these are just some of the issues that you need to navigate. It's not to say that you can't sort of structure your finances. We help a lot of clients in setting up their finances in Australia and paying US taxes, and it does just limit some of the opportunities from minimizing an Australian tax perspective. But I guess this does lead some people to think about whether they do want to relinquish their citizenship or green card, and this is a really important point. Now, some of the factors that are in consideration, which will be on the next slide here, and we look at, it's very personal on whether you do want to relinquish your citizenship or green card. We're never going to tell anyone that you should or shouldn't do it, because it depends on your personal circumstances. And these are the typical things that we see from most of our clients that we're speaking to, of the considerations that they're thinking through and some of the things that we'll raise. And, as we've talked about, the ongoing tax responsibility, no one wants. So that's a big consideration in it. But then there's, a really big important thing of being able to reside in the US, which is an important consideration and something that needs to be taken really seriously. We see a lot of emotional attachment to citizenship, which is completely understandable as well. And then things around there isn't a estate tax in the US that
some that are in that sort of higher net worth bracket need to be mindful of as they're sort of building wealth, and that might be a consideration around exiting the US system. And then the potential exit taxes, the hard acts, which Ashley alluded to a bit earlier, is a really important consideration. And just moving on to the next slide, we'll spend a bit of time on that. So the hard act came in 2008. Effectively, it impacts, I mean, it's a broad-ranging act, but for the purposes of today's discussion, we're talking about expatriating from the US or relinquishing your green card. So it affects US citizens that have renounced their citizenship, potentially, and long-term green card holders who have abandoned their legal right in the US. Now, it applies to green card holders that have held a green card for 8 of the last 15 years. A really important point of that is that it doesn't mean 8 full years. Typically, it will be, if you, let's say you took out your green card on the 10th of December 2015, 2015 will typically count as 1 year in that calculation. So it's, if you've been a green card holder in any part of that year. The other point as well to be really careful of is that your green card expiring does not, absolve you of this. You do need to file Form I-407, to actually sever, the ties with the US from a tax calculation perspective and tax filing perspective. So that is something that has caught some people out, unfortunately. Now, the hard act will apply to what they call a covered expatriate, which we will go through what that means in the next slide and who that applies to. So a covered expatriate is anyone that has an average, so you've got to meet one of these 3 tests, an average of 178,000 in US tax liability over the last 5 years. Now, to point that out, that is US tax liability. It's not your income. It's the actual liability, the tax that you're paying as a couple or as an individual. It's a pretty significant amount of tax that you would actually need to pay. It's not 175,000 of income. Your personal net worth being over 2 million at the date of expatriation, that is per individual. So husband and wife, 2 million each, or failure to certify on Form 8854 that you've complied with the last 5 years of your federal tax obligations, which is really important. So you need to file that form to make sure that this covered expatriate won't apply to you if the previous 2 tests do not apply. So just going on to the next slide, the effect of the exit tax. So if you are a covered expatriate, essentially it will be deemed capital gains on your worldwide assets, even assets outside of the US. So on the day that you expatriate from the US, it is a potential realized capital gain on your worldwide assets, even if you haven't actually sold them, of course. 401ks typically can be deferred until you're actually drawing them. There is a deemed, and also non-grantor trusts can be deferred until you're actually drawing them. The IRAs and also restricted stocks can be treated as a distribution of income as well. So that's another point to raise there.
It is worth mentioning, John, there is about a $760,000 capital gains exemption. So on that first point, deemed capital gains, capital gains tax would apply on everything above that exemption amount. So just wanted to put that out there.
Absolutely, absolutely. So, just going on to as Ashley mentioned, it's 767,000. So it's not from the first dollar of capital gains. It is from above 767,000 that it does apply. So I guess that is a big consideration for those that are considering relinquishing their green card or citizenship. There is a potential exit tax, and it is weighing it up. If you were doing it, what's the worst of two evils? Is it the exit tax or the ongoing requirement to file US taxes? That's really going to be personalised for every individual to work through. So just moving on to the next part of the presentation. Back over to you, Ashley.
John, now this is the problem when I try and multitask. So I'm typing and answering questions as we go, and then the very next thing you're about to say is, in fact, the
no, that's good. It saves me from saying it, which is good.
So distribution of retirement accounts to Australia, let me address this. Really, it's going to depend on your legal status. So I've just been answering some great questions that have been coming in, and I keep coming back to this point. So if you're a US citizen, you're always subject to US taxation. Therefore, the distribution of your retirement accounts really isn't going to differ. For the permanent resident, that's a little bit different because you can only be a US permanent resident abroad for about a year, maybe two, with some exceptions before that's forfeited. But it's interesting to note that still doesn't matter. And that's why I included in brackets there. You still, as John mentioned a moment ago, you still need to file that form I-407 to release yourself from the US tax system. So again, the tax treatment for number 1 and 2 would be the same while you're a US person. Third, however, is the temporary visa holder, and that's where things get very interesting indeed. So for the US person, it's really straightforward. It's exactly the same as domestic planning here in the United States, and that is if you have a retirement account, sometimes called a qualified account, your options are to distribute immediately, and you can do that. Unlike superannuation, you can do that. And in fact, that's why the ATO looks at US qualified accounts and says this is not a foreign superannuation program because you can get your money out any old time. Well, yes, you can, but there's a 10% penalty tax on top of your marginal rate of tax that you would need to pay. So not so attractive. So yes, you can get it out. You wouldn't be very smart to do that, though. Option B would be distribute over 5 years or more, taking a Section 72T treatment. Don't really see that too often. That's a lot of work, time, and expense to go to in order to eliminate the 10% penalty because you're still paying ordinary income tax on it. Now, the third option for a US person would be to simply wait until you're age 59 and a half and retired, and then distribute that account slowly so as not to bump up your US or Australian taxable income into the next marginal tax bracket. Now, I'll have an example of this coming up in a little bit. But before we talk about that, we'll cover what the situation is for a non-US person. So this is the Aussie who has been in the US, they've worked there for a while on a temporary visa, or the permanent resident that surrendered that upon returning to Australia, and hopefully they weren't deemed a covered expat as per the Hart Act that John just went over. If that's the case, then there's very good news, and that is you're able to utilize the Australian-US tax treaty to really bring that back to Australia and have the ATO tax it as a foreign trust. Well, why is that good news? Taxing as a foreign trust doesn't sound so great, but when you understand the principles of how that works, it is in fact good. And the reason why is because what's deemed the taxable basis of that account is the employer plus employee contributions. And if you think about who is in this situation, the temporary resident, they weren't in the US for all that long due to the limits on how long you can typically roll these things, although there are some investor visas that get around that. We'll save that for another time. But typically the folks that have done this haven't been in the US for all that long, maybe 5 or 8 years towards the upper end. And if that's the case, most of the account value is probably their contribution or the employer's contribution. So therefore the growth would be smaller, and therefore that would be the only taxable amount on the Australian side when returning. Well, what goodies are there in Australia that we can take advantage of? So happens there are two of them worth mentioning. One, the concessional contribution catch-up. So we're able to go back up to 5 years and pull forward those concessional contributions. So you can make that concessional contribution paying effectively a 15% rate of tax on the amount going in. That's going to be particularly attractive to you in a year, in an Australian tax year, when you've got less than 250. I would say the magic number would be between above 180 and below $250,000 of income. John, I'd love to get your opinion on that one, and I'll explain the reasoning for that in just a moment. The reason why is because the delta is greatest at that amount. That means you're contributing money into super, paying a 15% contribution tax, yet your marginal rate is at 45%, between 180,000 Australian dollars and 250. Above 250, you get hit with this thing called the Division 293 tax, which is, well, it's not a tax. I don't know if they call it a tax, but it is. I mean, in effect, it's where they increase the super contribution from 15 to 30%. So you're really only enjoying a 15% tax delta at that point. John, what are your thoughts on that super recontribution strategy?
Yeah, so it is ultimately going to be individualized, isn't it? So you've really got to work through, and ultimately, if you are on those lower tax brackets, absolutely, it can work.
Yeah. Yep. So it seems as though you get above 250, and then really we're looking at a 15% delta. But anytime I can get my client a 15% tax break, then I'm going to recommend that. So just getting back in a little more detail here. To do with U.S. retirement accounts, looking at 401ks and traditional IRAs, penalty-free distributions can take place at any time after age 59 and a half, and I should have included that here, and a separation of service. That's an important thing. And it's funny, for better or worse, mostly for worse, I do my best thinking out loud. And so as I go through these slides, I think, that's a really good point to add. I've come across this again and again, and John, I'm sure you have as well, with clients that work for global companies, and they leave the US and they say, great, I'm no longer working for the US entity, I'll be able to roll my 401k out. Well, not so fast. It depends on the definition that employer uses. And so I saw this most recently with a client who worked for a Ford Motor Company, which, by the way, is very interesting to say, Ford still employ engineers in Australia? Well, it turns out they do, in fact. No production, but they do have engineers in Australia. So this particular prospective client was leaving the US, coming back to Australia. And we said, get in contact with HR and ask what the situation is. Will your separation of service count and allow you to roll out your 401k? Well, it turns out it didn't. Because Ford, global company, they said, you're merely an employee now of an Australian branch. Not every company takes that point of view, though. I've seen it probably the other way more often. I'd say 2/3 of occasions, there is a separation of service granted, and that allows people to port over their 401k. But anyhow, I just went into a little bit of detail there. You can get it out before age 59 and a half, of course, assuming you're no longer working for that company. Pay that 10% penalty rate. There are hardship withdrawals. Again, it's not unlike super. I say to folks, with super, you can't get your money out before age 60 and retired, but you can. It's just nothing you'd ever actually want to have happen, like illness or bankruptcy or major financial hardship and other such things. Loans may be available from a from a 401k account. Traditional IRAs, you see the situation there, very similar. Distribution considerations and tax. So this is the point I wanted to just show you another website very quickly. So many folks will come back from the US and they'll say, right, I'm done. I just want to be over with all of these tax complications. And so they may wish to, if they're a US person, this is problematic, they may wish to withdraw their retirement accounts all at once. But let me show you why that mightn't be such a great idea necessarily. So I'll just go over here to Smart Asset and their income tax calculator. and show you this point. So using a New York zip code here, if you were withdrawing your $1 million US IRA or 401k, then you're looking at a federal tax bill of $359,000. Why is that? Well, the reason why is because you've been boosted. Here's my key financial data sheet. You've been boosted all the way through the marginal tax bracket scale to be in that highest bracket. So in other words, more of the money that you're withdrawing is getting taxed at 30%, excuse me, 37% than at these lower amounts. Now, what if instead, let's just lop a single zero off of that and assume you distribute the account in $100,000 amounts over a 10-year period. Watch what happens to that. So 22,659, let's multiply that by 10, $226,000. Well, there's about $140,000 delta right there. And that's the point that I wanted to drive home. So don't be so hasty and say, right, done with the US, I'm withdrawing it all at once, because that's just what I demonstrated there. That's just on the US side. I haven't even spoken about the Australian side, and tonight I won't be doing that. So what are the options here? Well, you can distribute and pay US tax as regular, ordinary US tax. This is if you're a US person. That's what we were just talking about a moment ago. Next, you could, hold on a second, distribute according to, yeah, okay, so over age 59 and a half, and you just distribute it as per usual in the US in a domestic situation. Alternatively, you could take it out any old time, plus pay a 10% penalty. Alternatively, you may use Section 72T, get it out in substantially equal periodic payments. That's the term of art used there, over a 5-year period. You could do that before age 59 and a half. Again, very rarely see that done in practice, because what's the point? Or alternatively, for non-US persons, you can use the Form W-8 and take a tax treaty approach. And this is really where it's at. So this is the foreign tax treatment that I was foreign trust tax treatment that I was referring to earlier. So some more detail here. We're not talking necessarily about retirement accounts on this slide, but Australia sets the tax basis on foreign assets on the date you resume Australian tax residency. So what does that mean? Let's say you own $1 million worth of Google stock or whatever stock it is. It's low basis stock. That's financial advisor and accountant speak for big gains in that stock. You move back to Australia. You were a temporary resident in the US. You've surrendered your incidence of US tax residency. You come back to Australia. Australia says, welcome back, mate. I hope you had a good time overseas. Say, I see you've got this Google stock here. What did you get it for? We don't really know what you got it for. We're just going to say it's worth the fair market value on the date you resumed Australian tax residency. What a beautiful opportunity that is. So what other planning possibilities might we include knowing that? I would say if you're in a mixed nationality spouse there, where you have one that is a US citizen or a permanent resident, then with some planning, you may gift certain assets, certain gain assets from the US person over to the non-US person to take advantage of that. Can you do that while you're in the US? Yes, the gift limits are a little bit different from one permanent resident to another. They're lower. They're not the unlimited amount that exists between citizen spouses, but still pretty high. I think it's 157, 159, somewhere in that range this year. And that's exactly what, actually, I shouldn't say exactly, similar to a strategy that I'm employing with a client, where we actually have a hard exit tax calculator that we've developed. And what we're doing is we're equalizing the estates between the spouses. So we have one spouse who seems to have all of the gain assets and is likely to be a covered expat, and a spouse who's far from hitting that status. And so the idea is to equalize between the two, hopefully not hit that covered expat status at all. But again, as John would often say, and I would often say, that having to pay tax is indicative of of a good thing. You've made money. It's not necessarily going to be to your benefit to simply be worth less to pay slightly less tax, even if there's a tax involved. In this case, it's often, especially given that 700 and what's that exact number? It was about 769,000, if I remember correctly, gain exemption. So there's a big gain exemption there anyway. The other thing to be mindful of is avoiding holding US sourced assets. And there's more to it than that, but in the interest of time, let's just say US located assets at departure for the non-US person, as those will not obtain a step up. They'll still be taxed primarily and first by the US. Okay. So what is the appropriate withholding amount? Let's say you were a temporary resident, you return to Australia, and you go and talk to Fidelity, or you go and talk to Schwab or whoever, and you say, listen, I watched this great webinar, heard from these two experts, and they said that there's actually a 0% withholding that's applicable here. And that is correct. However, this is the problem. Or TIA, CREF is another one that's on the dirty dozen list for this. The problem is these custodians, these investment brokerage firms, they have exactly nothing to gain by being in any way lenient and using their brains or their eyes in reading these treaties. And so sadly, in the past 12 months or so, we've seen a reversion to, and Schwab, I want to point out in particular, has taken a reversionary approach where they used to apply the 0% withholding. In other words, they understood it, they knew it was legit, but now they've reverted back to this 30%. So very often, doesn't matter what you say, how you try and elevate it, they're just going to say, we don't care, and we're just going to withhold 30%. It's not the end of the world, because withholding 30% doesn't mean you have a tax of 30%. It simply means they've sent it off to the IRS. They've said, we're not going to make the decision. That's between you and the IRS. And the good news is that's a very, very solid and I mean very solid interpretation, that 0% withholding for non-US persons, for Australians only. So you'll get that money back, but it is a hassle. You got to file a return, wait until the end of the financial year, and then post April 15th, and then you can file for that. So that's the situation there. John, over to you.
Yeah, so the other topic we wanted to cover today was estate planning and some of the considerations that you will have as Aussies returning back to Australia from the US from an estate planning perspective. So just going on to the next slide here, really the cornerstone of any estate plan, as I'm sure all of you know, is having a valid will. Now it is a little bit more complex when you do have cross-border assets. So if you've got assets in the US and Australia, there is a little bit more complexity involved, and making sure that the will is recognised in each location. So this is something that an estate planning solicitor would certainly guide you on. But what we've seen and what most of them would say is that having a will in each location where the main assets are located is important. So for those of you that are coming back from the US to Australia, and you might have property or significant assets in the US, it is important to make sure that you've got a valid will in the US and having one in Australia. So it is really important to make sure that they speak to each other as well in terms of the wills. We have seen it where an Aussie over in the US will get a will drawn up in the US and then come back to Australia, have another will drawn up, and the wording of that will actually say this will supersedes every previous will that's been written for Jane Doe. That effectively cancels out the US will. So it is good to have the solicitors talking to each other, making sure that the wills are both recognising each other, and if you're going to go down that path, and making sure that they don't cancel each other out, making sure you've got valid nominations on things like your 401k, because they'll often have a nomination on them to say what you know, how they should be distributed upon your passing, rather than going through a will. The other point we wanted to make, and again, we've raised it earlier, but in relation to family trusts, now trusts are a really popular vehicle for estate planning purposes, definitely in the US, you know, also in Australia as well, because the assets within a trust don't actually pass through an estate. They typically you know, continue on to the the surviving beneficiaries. But it is important to think through the tax consequences of a trust. You know, there are you know, Australian tax benefits from having a family trust, but if you have an Australian family trust, those tax benefits on the US tax perspective may not translate across to the US return, because the ability to pick and choose who actually receives the income each year on their personal income tax return typically isn't there from a US tax perspective, and there are extra requirements in filing which can be quite complex. So that's a really important thing to bear in mind with the family trust. In Australia, it does lose some of its benefits through your lifetime. The other thing to bear in mind, those that are coming back as a green card holder or a US citizen, there is unfortunately US estate taxes to keep in mind. So essentially it is at the moment, a lifetime limit for each US taxpayer of 12.06 million as of 2022. That is exempt from any estate taxes. That's in terms of your net worth, essentially, individualized for each US taxpayer. Anything above that is potentially taxable to your eventual estate, and that is your worldwide assets as well, so not just the US assets. Your lifetime gifts can potentially reduce that threshold. So if it's a gift to a US citizen spouse, that's completely fine. But as Ashley mentioned before, for those of you that are returning to Australia, or you know, those of you that aren't US citizens, or sorry, have a spouse that isn't a US citizen, and you're passing assets to just an Australian citizen, if it goes over the annual threshold that you've got, then, which is I think 164,000 this year, the portion above that will reduce your eventual estate tax exemption. Gifts to children or anyone else above 16,000 will reduce that lifetime limit. So you've got to be careful on lifetime gifts. Now, the other thing to point out as well is that at the moment it's 12.06 million. It is legislated at the moment to reduce to 5 million in 2026. So that was a temporary increase that I think President Trump put in a few years back.
Tax Cuts and Jobs Act of 2017.
Yeah, that's it. So it is actually legislated right now to reduce the 5 million, which will bring a lot more, you know, a lot of other estates into the mix with this. And the other thing as well is that there is a lot of push within Congress at the moment to potentially reduce it early. Whether that gets over the line or not is to be determined. But you know, definitely watch this space in terms of the gift and estate exemption cap. But moving on to the next slide. For those of you that aren't US citizens or green card holders but still have assets in the US, there's just one quick point to note, is that technically US domiciled assets like US bank accounts, US domiciled property, US domiciled companies, shares on the US exchange do come into US estate tax calculations. As it sits under US tax law, anything over 60,000 as a US taxpayer, as a non-US taxpayer, the rest tax is applicable. Thankfully, for an Australian citizen, there is a double or an estate tax treaty. Australia is one of the lucky countries that do have an estate tax treaty that essentially means that even if you are a non-US taxpayer, that you are treated as such from an estate tax calculation if you have assets still in the US. So it's still that 12.06 million. Those that have got a lot of net worth do still need to consider it, even if they do or aren't a US taxpayer. So back over to you, Ashley, on US tax compliance.
Thanks so much for that, John. That's fantastic. So we're talking here about tax compliance, and here's the thing to be mindful of is that US citizens and green card holders need to continue filing their returns even if they no longer reside in the US. And that's kind of the corollary of what I was saying in the very first section there about, to do with the definition of a US tax resident. It doesn't necessarily mean you're going to cop a bill from the IRS. That's what a lot of folks think. I suspect when they first hear that, they say, "Oh man, I'm going to get double taxed." Not often, to be honest. It's pretty rare that double tax occurs, but it can occur, and there are some gotchas that I've listed down here, and John went through a little bit earlier. But one of the mechanisms that works to prevent this double taxation, there's really two main mechanisms, but one of them is the foreign earned income exclusion. So if you're overseas, let's say, well, overseas from where I am right now. So if you're in Australia, you're a US tax resident, you're making money in Australia, the IRS says, well, we're going to just forget about the first $112,000 of income that you make. Oh, and by the way, above that, we're going to give you a foreign tax credit. So whatever you paid the ATO, we're going to say that's a credit against your US taxes on the same income. So you don't end up paying double taxes typically on ordinary income. However, there are some gotchas, and John went through these earlier. The sale of an Australian primary residence. Would you believe I was just dealing with a client today where that's exactly what he's looking at? He's staring down the barrel of about $1 million in gain on his primary residence. He's held his home in Cairns for many decades, and it has appreciated. Well, he's a US citizen. His wife is not. They own the house 50-50. So he's on the hook possibly for significant capital gains if he sells that and doesn't employ some other strategies before doing so. Australian Family Trusts, which John already went through. Australian Managed Funds, which John went through in talking about. That's really PFICs, passive foreign investment companies, and then of course self-managed super funds. These are the gotchas where you can end up owing the IRS extra. So informational reporting, two main forms to talk about tonight. And gosh, I feel bad. It's just the graveyard shift coming on, talking about tax filing. My goodness, is there anything more dull than this? Thankfully, I can say the answer is no. There's nothing more boring than this. But here are the two forms you really need to know about. This is the public service announcement. So be sure if you meet the thresholds, if you're a US tax resident and you meet the thresholds, be sure that your accountant, if that accountant is you, then you be sure to make sure that these returns, the informational returns, are filed, because the penalties are stiff, as you're about to see. So FATCA came about from the Swiss banking account scandal in the early 2000s. It was 2008, actually. It was a fascinating story. A UBS Swiss banker, he became what's the turn of phrase? I forget right now, but he spoke out against UBS and the practices that they were employing, and he ended up being the largest beneficiary ever of the tip scheme that the IRS has when you report abuse. And so he ended up, it's quite a remarkable story. He ended up with something like $68 million, but he had to spend, because he was part of it, he had to spend some time in jail. So he made out pretty well from it, but he was a party to the crimes also. Anyway, so the reason that FATCA really gets the attention of foreign institutions and why there is a special box when you open a bank account that says, are you a US citizen? Is because that institution will be fined. That institution will be fined. So, and you will be too if you're above the reporting thresholds, which we can see right here. It is fairly complex. That's why I've included a table. So it does depend on the residency status of the individual and the filing status of the individual as well. Thankfully, these webinars are all recorded. So if you want to come back and look at this at a future point in time, tomorrow, this will be up so you can have a look. FBAR, Foreign Bank Account Reporting Act, has actually been on the books since 1970, but like many laws in the US, it seems as though it's selectively enforced. And it really only came, I'd say, into prominence at around the same time as FATCA. And one of the most fascinating and cryptic comments that I've heard from a leading tax attorney in this, if not the leading tax attorney in the US-Australia space, Marsha Dungog, who's now at Withers, she made a point when I said to her, I said, well, Marsha, the IRS is in a state of shambles right now. It's been underfunded. You just try and call them and you'll wait on hold for an hour and then they'll hang up on you. It's absolutely terrible. She said that may be true. I'm not disputing any of that, but where the IRS has made their investments is in artificial intelligence and being able to automatically flag things that are not in compliance. So they don't need to audit you. So who cares if their budget for audit has gone down? There's no audit issued when they send you a deficiency notice. And I thought, wow, that is an A+ answer, and you've convinced me. So well done, Marsha. So FBAR is bad news. If you've got more than $10,000 at any point throughout the year in aggregate across all of your bank accounts, then you better file one of these. And they changed their name a few years ago. They're now called FinCEN 114s. And that's the rules right there. Here it is on FATCA, Form 8938 for those IRS form geeks. That's the form number there. And there's the summary of information. So where can we learn more? John, maybe you just want to take a moment. Where, if someone wanted to reach out to you and because they felt a need for your services, how would they get a hold of you?
Yeah, so but the best way would be through our website. So if you go to apt12.com.au, you'll see an expat services page and a dedicated page for US Australian financial advice, which actually you're kindly enough bringing up on the screen there. So expat services, US Australian advice. There is a if you click through there, Ash, then there is a contact us section there. And you can make an inquiry to have a chat to us in relation to your affairs. So a very quick form to fill out.
And in my case, very similar actually. It's just come to Arete-WA, WA for Wealth Australia. Go to get started, schedule a fit call. That'll take you right down here. I would encourage you to read these things, by the way. There's a lot of good information contained there, and then schedule that fit call, and we can find a time to talk from there. But with that all said, let's transition. Oh, actually, key financial data sheets can be obtained from my website. Let's transition over to Q&A. There were some questions asked, John, while you were speaking that I was able to write and answer live. Some not so much, but we still have a couple outstanding right here. Does superannuation fall under FATCA? I believe the answer is no to that. John, do you know differently?
I believe it's no. In terms of FATCA, in terms of FBAR, it's a bit of a grey area, and I've seen some people say it is and isn't. It is a anti-money laundering form, FBAR. So I always say, when in doubt, add it onto your FBAR, but in terms of FATCA, I don't believe so.
Yeah, and that's really one. My experience has been that we work with fairly mainstream, reputable, conservative accountants. There's a spectrum of advice out there. If you go shopping hard enough, you can basically buy the opinion that you want. Whether it's going to be right, whether it's going to hold up in court or under audit is another matter. But that's what I would say there. So I'm going to pass the ball on that one. I think it's okay, it's exempt, but it probably, given its reporting, really wouldn't hurt just to report it, would it? Because you're not being taxed
Right.
on.
Yeah, it is. It is the FBAR. It's a bit of a misconception sometimes that it is a, you're going to be taxed on it if you do report it. But if it is a more of an anti-money laundering reporting, form. So I think when in doubt, add it. But speak to your tax professional as well.
Yeah. Next, Adam. Hi, Adam. Dual U.S. Aussie citizen moving back to Australia in January. Okay, welcome back. I'm planning on leaving my U.S. company, meaning his own company, and earning income from in the U.S. Anything else I need to consider? I mean, honestly, John, maybe you feel the same way. There is too much to consider for us to succinctly answer that, because there's all kinds of strategies inherent in what you're talking about there. I don't mean to give a non-answer, but it's like, well, there's just too much there to talk to you about with that situation. Anonymous attendee, John, I think this one's yours to do with the Hard Act.
Yeah, so it does come into, in terms of the Hard Act, there are some considerations around transferring assets, one from just a pure capital gains tax perspective, and transfer of assets, depending on where you are in the world, can have implications for the $2 million net worth. But it is a strategy that some will deploy, where you will transfer assets between husband and wife, staying under thresholds and being mindful of any capital gains tax on transfer of ownership, to potentially get you under that individualized $2 million limit. So, but definitely get advice around that strategy, because there are a lot of things to consider and work through. But that can be a strategy.
Laura Wade writes in, hi Laura, it's been a while. Is it most tax efficient to sell any stock shares in the US before departing, or once you're back in Australia for a US and non-US citizen? Okay, I would say for the US citizen, it's going to depend very slightly, because there is a crossover point where it's hard to believe, but it's actually the capital gains tax is actually lower in Australia for very high income earners, and but only if you're not, if you could choose between the two, then the lower would actually be in Australia when you've got gains of more than about $600,000. And the reason for that is long-term capital gains in Australia, 22.5%, versus in the US, 20% at federal plus 3.8% federal tax, 23.8%. So fractionally cheaper. And that's not even including any US state tax you may have. So things could get less advantageous on the US side there. It is hard to tell, Laura, just with the way that question is written, if you're wanting us to compare, or if you're talking about a spouse, or once you're back in Australia for a US and non-US citizen. Is it like, John, I don't know if that makes any sense.
Yeah, no, definitely. And it is working through individual circumstances. The other thing to just note that those that are actually on a temporary visa in the US, there can be some advantages actually waiting until you come back to Australia. Just the way it can work. And please don't take this as personal advice. I'll put that initial disclaimer in there. But if you're on an E3 visa and leaving the US, and you've got an employee share scheme and you've made some capital gains, it can work where you actually wait until you exit the US system. Don't have US filing obligations. As Ashley mentioned, you come back to Australia, they're only looking at the point that you return to Australia as being, essentially when you've, in their eyes, when you've purchased the asset. There can be some advantages in waiting till you come back to Australia, but it's a complex area and there's too many things to consider. And definitely get advice on, especially if it is a substantial amount, to make sure that you're timing the sale at the right time, because yeah, whether you sell it in the US or in Australia can have big implications.
So, John, we've got two questions that are essentially the same thing, and it's a great question, and it really suggests we need to do a better job delineating who is best suited to what client circumstance. But anonymous attendee here, maybe it's the same anonymous attendee, who knows? But they ask, dual citizen currently in Australia, who is better suited, APT or Arete? And then again, a different permutation, same thing. Trying to distinguish between your two organizations. So here's the thing. My firm, Arete, we're a US registered investment advisory firm. So what does that mean? Essentially, we can assist you. We do our best work with US assets and US strategies. We understand the Australian situation, but I'm not licensed in Australia. If someone was moving back to Australia, then I say to my clients, and John knows this because we have joint clients who've done exactly this, say, I'm not going to be your best guy. If you're living in Australia, you want someone that is working the Australian tax system day in and day out, and I can assist in managing those investments and helping transfer them back to Australia. But if you're living there, really, I think you'd best talk to John. John, what's your take on that?
Yeah, no, exactly right, Ash. So we're Australian-based, handle Australian assets. We have an understanding of the US and the US tax as it applies to Australian assets. We'll deal with US taxpayers in the US on their Australian assets, and US citizens living in Australia on their Australian assets. Where there are US assets that need to be, need advice and need management, that's where we'll bring Ash into the mix. So typically it's either one of us, or it's sometimes both of us where there's significant assets in both countries. But yeah, it's really where the asset is situated, and where the bigger asset pool is where you would usually speak to. But ultimately, send a request through to either one of us if you're not sure. And I have often determined that Ash is the right fit, and we'll say, that's not me, that's Ash. And Ash has done the same, where he'll say, yeah, that's actually better suited for APT, and send it through. So if you're not sure, please just reach out to either one of us and we'll determine it for you.
Just swapping over to the chat here, just trying to look at the timestamps of when questions came in to be fair. Christy Blake writes in and asks, you mentioned previously about being a green card holder for 8 years or more. What changes at this point in terms of taxation? Is that going to be a reference over to a Hart Act white paper or a webinar or something? John, maybe.
Yeah, so it is the trigger for being a covered expatriate that we mentioned before, the 8 of 15 years. So then basically, when you relinquish that green card, the covered expatriate calculations come into effect. If you do it before that, then you won't, even if you do have 5 or 6 million of global net worth, and you've only been on a 3 or 4 year green card, you won't have to worry about the exit tax. So that is the trigger for the potential exit tax if you have the tax liability over the previous 5 years of over the threshold, or the global net worth over the $2 million threshold per individual.
Christy follows up with, regarding 401ks, if you choose to withdraw it after you reach retirement age at 15 and a half, where can you deposit it to? Does it have to be a US bank account, or can you transfer it to Australia? And can you withdraw it in one lump sum, or must you withdraw it in increments? Excuse me. So the answer to that is very easy, and that is, it's really going to depend on your custodian. So if you're working with Schwab or Fidelity, they will allow, they actually have, it's a little known secret, but they actually have foreign exchange desks within them. And so they will convert it for you, not at the best rate. We've actually negotiated with OFX for a rate better than any other offer out there. So we get half of the retail rate for our clients. So what I would suggest you do, to answer the first part of your question there, Christy, would be to distribute it to a bank account, from a bank account over to OFX, assuming you're outside of the US, because if you're inside the US, I would recommend Interactive Brokers instead. So over to OFX, convert it, and then send it over to your Australian bank account. So that's the mechanics of that move. Do you have to take it all at once, or can you take it in increments? It's up to you. You can take it in lumps. Either. They're both fine. They're both fine. Stephanie, you're welcome, and thank you for further clarification on that previous question. I'm just going to go back and read it. So, spouse is U.S. citizen. I am an Australian citizen. Is the most tax efficient selling stock shares in the U.S. before departing? Definitely not for you if you have no instance of U.S. Tax residency, because you would get the step up in basis. So my back of the envelope recommendation there would be move gain assets into your name and non-gain assets into your husband's name or spouse's name. Don't mean to be presumptive there. Red Mush, I bought individual US stocks through ComSec. Okay, the reason for that is because you can't trade it if you're not a US resident. Fair enough. That's through Pershing, and you get to pay their big fat trading fees. The other option is to have it managed by a broker in the US. Any gotchas there? Well, I mean, in all honesty, the brokers don't work for free either. So I guess you're going to pay one way or the other. I mean, to be honest, it's a self-serving answer of me, but it's an honest one. And that is, you could either do it yourself and pay ComSec and Bank of Mellon Pershing their extraordinarily high fees and whatever other management fees are on the other end, or you could pay someone who can give you value-added advice and do it that way. And we have no fees actually on trading in the US with Schwab or Interactive Brokers for that matter. So it's up to you. Ian Turner, John, do you want to take that one? Swapping over to the chat panel.
Sure. So being over 60 in the US for 12 years and moving back to Oz in the next 12 months and achieving a sailing permit from the IRS, what are the immigration issues if I wish to come back to the US from time to time? So yeah, that one is probably better suited to an immigration professional, probably not something that you and I can answer. Ash, do you know the answer on that one?
Let's see. I was reading other questions. Forgive me there. Being over 60 in the US for 12 years, mergers in the next 12 months, and achieving a sailing permit. Oh, interesting. A sailing permit. Wow. What are the immigration issues if I wish to come back to the US from time to time? You know what? You're in luck, actually, because I know two great immigration attorneys I can refer you to. There's my friend Andrew David, and there's also Chantel Merkel in New York. They would be the people who ask about that one, guys. I've been asked a lot of questions, but not that one before.
Sorry, Ian.
Sorry. Gerald, lovely to see you here. It's lovely to see a lot of folks here, including my brother Jeff as well. Hi, Jeff. So Gerald, short and sweet answer is Interactive Brokers, bar none. No one beats Interactive Brokers for foreign exchange. And Greg, check out Interactive Brokers if you have the ability to do that, because with Wise, so OFX and Wise are pretty much neck and neck. They've moved to algorithmic pricing, so it used to be a flat 60 beep spread between the interbank rate. We've negotiated 30 with OFX, so that's pretty good. But still, when you're doing $1 million exchange, that's still going to be about $3,000. You compare that to 0. Whatever it is, it's like 4 decimal places 2 with Interactive Brokers, and you're paying like $28. It's ridiculous with Interactive Brokers. But anyway, that's the answer to that question there. And I think we might be getting towards the end there. You're welcome, Christy. Stephanie writes, married, filing joint, 1 US citizen, 1 Australian citizen with permanent green card living in the US. We have assets in the US under 200,000, mostly foreign goods and IRS. How do we just leave them untouched? Well, that's easy. How do you leave them untouched until we return to the US? I'm going to have to read that again. How do we just leave them untouched until we return? Well, I guess there's 2 answers to that question. One, do exactly that. I don't mean to be a smart aleck, but I mean, literally just leave them there. And either your, let me see, is it an IRA or is it a 401k? assets in 401ks and okay, so both. IRA is probably not going to, I mean, never say never, but probably nothing's going to happen to that. And the 401k is going to be, I mean, depending on how many years we're talking about, in all likelihood, it's going to continue as well. So you just leave them there. What I would probably recommend would be rolling them over to IRAs and with Schwab or Fidelity or whoever, and then just letting them ride there, because I think they're pretty solid. They're not going anywhere. Hi Ash, thanks for looking at my question. Please let me know about Andrew David and the other person you mentioned. My email is Ian Turner. Okay, I will go talk to Andrew, and he'll be happy to help. I am going to guess that there are no other questions. It has been a pleasure. It's now getting close to bedtime here. So thank you so much. And we'll see you next month, where I'm doing a webinar with Dylan Goldspring from CDC Corporate on Australian inheritances and how they work. So fantastic. We'll see you all next month. Have a wonderful rest of your day or evening.